Is the UK's housing market going to boom or bust in the next few years? To get a clear view of whatever the future may hold, we first need to understand where we are right now. And where we are right now is interest rates are at all-time lows, which helps the average person in the UK afford bigger houses than what they normally could do. Now, if interest rates go up, especially if they go up significantly, and by significantly I mean more than 0.5%, we could see a drastic turn in the housing market. And the reason why it'll be different this time as opposed to any other time they've gone up in the past is the affordability ratios are at all-time highs. Now, the affordability ratio is just the average house price in the UK divided by the average income in the UK, which is what I'll show you here. Now, these figures are from the Office of National Statistics. You can go on their website yourself and download these figures to have a look. They also have different charts for each area, each city in the UK, which could be useful if you want to know what the ratio is like in your town or city. One thing I'll mention, I did get some numbers off statistica.com, and some of the numbers, some of the ratios I was getting was a bit higher than what's shown here. I'm assuming that's just because it was measuring the whole of the UK rather than just England and Wales, which is what the Office of National Statistics have done here. I do suspect some of these numbers are slightly rigged to make it not look as bad as what it really is, but nevertheless, if you look here, in 2007 we peaked at 7.17, and on the run up to 2007 you can see the affordability was a lot better. 1997 it was only 3.55, and then it gradually works its way up. So it's getting harder and harder to afford a house at this point. And on the run up to 2008, in 2007 the interest rates was 5.5%. So that's quite high compared to where we are today. But there's still a lot of people buying houses, they're still able to afford it a lot better to where they are today. And as I say, these ratios have nothing to do with the interest rates, they're just purely the house prices divided by the average income. And of course, after the great financial crisis in '08, they dropped interest rates right down to 2%. In 2009 they dropped them down to 0.5%. Once the gap in the affordability and the house price gets too wide, it would naturally come down because obviously people can't afford to buy a house. Therefore, house prices would have to come down, in theory. And when I say in theory, the reason they may not actually come down is because commodity prices are going up. Shortages of materials, if all this shipping crisis and so-called energy crisis carries on, it's all going to push up the price of materials. And when the price of materials goes up, there's less people willing to build a house, less builders willing to build a house from scratch, because obviously their expenses go up. And if they start climbing at the rate they have done in the past 18 months or so, or more like 12 months, well, it'll be very hard for someone to predict what it's going to cost if they start putting in the footings tomorrow, but they don't expect to have that property finished for another year, 2 years, maybe even longer, especially if they're building an estate. The cost can spiral. So a lot of developers, they don't want to take that risk, especially if they rely on pre-selling some of the homes to fund the project, because that would mean they'd have to sell at today's house prices, yet it may cost them tomorrow's, and when I say tomorrow's I mean in 3 or 4 years, prices for materials which could have shot up exponentially, along with labour as well. So even though if interest rates do go up, which will initially drop house prices down, we may also have a supply issue of no or very little new houses coming onto the market. And another thing that's kept house prices up quite high in the past 2 years is there's recently, I think it might have been the back end of 2020 or earlier this year, there was a law passed in the UK which would actually allow the banks and financial institutions buy homes and let them out. So you've got banks like Lloyd's, which are now buying quite a lot of houses, and what they're also doing is anyone who can't pay the mortgage and the house gets repossessed, the banks are actually keeping that house and letting it out. So as you can imagine, that's massively restricting the supply of houses which are coming onto the market right now and will do in the future, which could keep house prices up high. And if you think how insidious it is really, someone may have paid off half the mortgage or more, which the bank has regained most of their capital which they lent out, and now they've basically got a house free of charge almost. In some cases it's probably even more so, they've probably profited on the mortgage and they've got a house free of charge which they can rent out. See, it may be hard to predict what the prices will do in regards to when, but one thing that we know for sure is with this, what's happening with these commercial banks and bigger financial institutions, is they're basically literally monopolising the housing market. Because like I say, before they couldn't do it, but now they've got the green light to rent them out themselves, which will send prices to the moon, because they'd obviously rather rent them anyway, because they'll make more off the rent than what they would a mortgage, at least with today's low interest rates. But also with the rent, they've not really got as much of a liability, have they, as what they would if they loaned out a mortgage. And it would be a fair argument as well to assume that rent prices could go quite high as well as a result of that. Now, I believe the reason why this is happening is because they're getting ready for the transition into a central bank digital currency. If you don't know what a central bank digital currency is, just quickly Google it, have a look. I do have another video on them and what it will mean for us. But it's essentially a digital currency issued by a central bank, in the UK's case the Bank of England. So basically it'll have nothing to do with any commercial banks. But like I say, if you don't know what it is, just have a quick look what it is and then come back to this video and it'll all make sense. Because once this central bank digital currency comes into play, these commercial banks won't have any way of making any profits. They won't be able to offer any financial services. So all these big powerful figures which are in charge of these commercial banks, they're not going to roll over and just quite happily, hand over all that power. So in effect, they've basically been gifted the housing market. If they can monopolise the whole housing market, residential, in the UK, and they'll probably end up doing it worldwide as well, wherever there's a central bank digital currency being issued, well then that's their new business. They're basically landlords and landladies of the entire country. They'll be able to charge what they want for rents. They may or may not sell houses, but if they do, then because it's a monopoly, you're going to be paying whatever they want to dictate that house is worth. And in my mind, they'll more than likely just keep them off the market and rent them out. This is unfortunately the grim future I can see for the UK housing market, at least residential. I'm going to do a separate video on commercial property, so make sure you catch that. It'll be coming out in the next few days, so make sure you have a look at that, because that's just as interesting, the major shifts which are going to happen with commercial property. But as far as residential goes, will this even put many on the market? You see, in the past, what's happened, like with the '08 crisis and with in 2009, 2010, a lot of properties come onto the market, so there's a lot of supply and low demand. So if you was in a position to buy a house then that was a great time to buy a house, even though the affordability ratios, which I've shown you before, aren't as great as what they were in the past. It was still a great time to buy bargain houses. But next time there's a crash just like '08, and believe me, there will be a huge crash at some point, and the interest rates may be forced to go up because of inflation. If that's the case, even if they do let some houses onto the market, who's to say you'll be able to afford what you think you can afford if they have to raise the interest rates? Even if you're living in a house now which you own, you've got a mortgage on, would you be able to afford it if the interest rates went up exponentially, like 2 or 3 times what they are now? So these are things you need to think through if you're in that position. And I know a lot of people are saying they wouldn't raise the rates that high because it'll crash the economy, this, that, the other. But at the end of the day, how do we know that for sure? We wouldn't think they would, because they depend on asset prices to keep things afloat. But after what I've just told you, you can see a lot of this 2030 agenda being played out. And what happens if you might have a 5-year fixed rate mortgage? What happens if you go to, the time comes where you have to renew your deal, and you're going to be paying an exponentially high interest rate? Is it worth remortgaging and locking in a 10-year deal now, maybe? Obviously your situation's different to mine, and I'm not a financial advisor, so anything you do is your own decision, but it's definitely something to think through. I think we'll be okay for the next couple of years at least. Bank of England have threatened they might raise them next year, but I think it's unlikely. And if they do, it probably won't be by much, so it probably won't make much difference. But if inflation takes off heavy in the next few years, who knows? If we have a repeat of something similar to 2008, demand might be low, but so the supply might be low as well, so they may keep those high prices. Anyway, I'm going to do a part 2 to this because there's quite a lot of scenarios which could play out here, so make sure you keep an eye open for them. I can't hear anyone else talking about this, guys, anywhere on YouTube. I know people have talked about the issues of these commercial banks now being allowed to buy up residential properties and, to keep them and let them out after someone's house has been repossessed. But no one's really talked about what's going to happen with the prices in the long run if the supply is, heavily restricted. Even after a crash, like I say, the prices could remain artificially high just because even though demand is low, supply is even lower. No one seems to be covering it, at least not that I know of. I mean, drop a comment in the section below if you know someone else talking about this, but I can't see anyone talking about it at all, and this could be a huge issue. So yeah, if you found this video informative, make sure you like, comment and subscribe, and I'll see you in part 2.